Hi there, Etoro. It is Monday, the 31st of January, and that means it's time to take a look at what moved the markets last week. Now I have the SP500 and the Nasdaq 100 up here on screen. The past 5 trading sessions, Monday to Friday last week, are here, and you can see the purple line is the Nasdaq 100, and it ended the week slightly lower than when it started, and the SP500 is the other way around. So it ended the week slightly up from where it started. Now, the week-long performance hides the volatility that we experienced during the week. Obviously, you can see them by the candles, but I also encourage you to look at the wicks. So these thin lines on either side of these candles show you the breadth that the market traded at through last week. It was one hell of a ride, and this is somewhat disguised by the nearly flattish behavior of the indices for the week. I also like to look at the Nasdaq Composite. So there's been quite a difference between the Nasdaq 100 and the Nasdaq Composite through the past, I would say, year or more. The Nasdaq Composite holds a lot more companies, and not just the big wigs. There are lots of medium-sized and smaller companies in there too. So it also ended the week slightly flattish, but is now firmly in its 66th correction since 1971. So since the highs of November, which were kind of touched again in January, we're now down more than 14% for the Nasdaq Composite. Now, it really sucks when a correction or a bear market just keeps on going. Keeping the faith, as it were, is a bit more difficult the longer it wears on. But I like to, first of all, look back at data for those indices and the market in general, historically. And so, for example, here on screen, you can see a table of corrections in the Nasdaq Composite going back to 2007. Now, going back even further, statistically, roughly 1/3 of corrections result in a bear market beyond that, but 2/3 don't. So the statistics are on your side in terms of the frequency of bear markets following corrections. And as we all know, the markets follow GDP, which continues to grow year after year. And so ultimately, while we experience some volatility in the short term, and sometimes for months or quarters, or sometimes years at a time, the market does continue its slow onward march upwards and to the right. Another way that this table might make you happy, in a way, I guess, is that you can see that corrections happen quite frequently. I'm also sorry to say that the current correction we're in is not the last one that you'll see if you're an investor for the rest of your life. You've probably got a few dozen of them coming your way over the next few decades. So whilst it is uncomfortable in the moment, take heart in that it's just part of the process. So the major US indices, the ones that hold the bigger companies in the US economy, they have charged through 2020, 2021, whereas the IWM, the ETF that represents the Russell 2000, was flat through last year, and we can see now that it's been down through the beginning of this year, roughly at levels that we last saw in December at the end of 2020. Again, this has been painful for those that have held good quality companies that might be in this index. They've just had a bit of a challenge catching a bid. But whenever you see this type of behavior across an entire sector or segment of the economy, you should be asking yourself, where is the opportunity here? And there are lots of opportunities in the Russell 2000 at the moment. There were also a number of Chinese stocks that took a bit of a beating through last week. And there are a few reasons for this. I'll speak about them in a moment. But you can see the CSI 300 on screen, which is largely considered the equivalent of the S&P 500 out of China. And it has fallen into bear market territory. So it is more than 20% down from the highs that we saw in February last year. It did touch this point in July briefly last year, but for the past 2 months has just been in another downtrend. Okay, so what are the root causes for this action that we're seeing across these markets through last week? Well, the correction just is continuing, and nothing creates selling more than some selling. So, and vice versa, by the way. People buy things just because other people are buying things. When the market enters a correction or a bear market, investors become nervous, and it takes some while for them to regain their confidence. However, looking at the start and end of the major indices last week, it does seem as though the selling has lost a little bit of its steam. Of course, we also had the big Fed meeting last week, and now all the major banks and analysts are talking about how many rate hikes we might see through this year and the size of those hikes. Some of them calling as many as 7. The news from the Fed was more or less as the market expected. So I'm not sure it had any influence on the markets. They were volatile before last week and volatile through last week. So it's very difficult to say. Another reason for the price action that we saw last week is that there were some pretty big names reporting earnings. So I'm not going to call them all out, but you probably recognize some of the logos with the likes of Visa, Caterpillar, McDonald's, Apple, Tesla, Microsoft reporting. And by the by, earnings were pretty good actually. One company that I did want to call out specifically, and it is a company that I own, is Visa. They posted their first quarter's financial results, and the results were very good. So payment companies and certain types of fintech businesses have absolutely been smashed through the past 2, maybe 3 quarters, depending on the exact type of company that it is. Visa's earnings last week were so good that the stock popped, I think it might have been more than 10%. And a number of other payment companies or companies involved in payment technology have also popped on the back of this news. I think we might see a nice chunky reversal of price action on some of these types of companies through the coming quarters. I think the market has been thinking that payment companies and companies involved in the payment ecosystem might do quite badly because retail sales in the US were very strong coming out of the crash in 2020 and have become a lot more frothy in recent months and quarters. However, there are a few permanent changes I think that we're going to see when it comes to payments. One being that more people are going to be transacting online than ever, and that's going to be a pretty permanent change. I'm sure your grandma, for example, is now buying things online when she might not have if she wasn't forced to because of lockdowns and the pandemic. But also specifically that people are buying more travel, hospitality, and kinds of services at the moment, and I think that's a trend that's going to continue through this year. As I mentioned, the CSI 300 took quite a spanking through last week, so there are a few reasons for this. It's the Chinese New Year through this week, so Chinese markets will be closed. And although the Chinese government is doing quite a lot to stimulate the economy, they are also doing things such as cracking down on corruption in various different ways. Beyond this, they also have their COVID zero policy, which might be more harm than help. That remains to be seen. China is integrated tightly with the rest of the world economy, and if they're experiencing lockdowns for large parts of their economy, not only is their economy going to slow down, but the global machine is going to be forced to slow down. The other big ticket item that is affecting the world at the moment, as well as the stock market, is of course the conflict between Russia and the Ukraine at the moment. This is a wild card at the moment, and it feels as though tensions are escalating. There's a lot of chest thumping going on, but there are some real moves being made, and I'm becoming increasingly worried about this. So putting this all together, what does it mean? Well, we saw a lot of choppiness in the US indices through last week, a lot of volatility, but ultimately the major US indices didn't really move that much from start to finish last week. It is beginning to feel as though we're at or near a bottom for this correction, but no one can really tell you that for certain. However, earnings have been very strong, stronger than analysts had been expecting. So I've highlighted a statement here. So 33% of the S&P 500 companies have reported results so far, and 3/4 of them are exceeding the consensus for earnings and sales. This was something that I mentioned, I think, towards the end of Q4 last year. Analysts had been overly pessimistic when it comes to their growth outlook for companies, which translates into economies around the world. I think that this is starting to put a bottom under the market. Investors are seeing companies that are posting very strong growth and also issuing pretty strong guidance for the year to come. I also think that the actions that China has been taking in order to stimulate its economy will start working. There's always a lag between when a macroeconomic action is taken and it reflects within the economy. Investors are very nervous when it comes to China because through last year, Chinese stocks did very, very badly. So understandably, they're nervous about getting back in, despite the number of measures that the government has announced in order to stimulate the economy and the companies within that economy. So overall, I am cautiously optimistic. However, the wild card, as I mentioned, is the looming potential for war. If this does happen, then all bets are off. I encourage you to watch this video by 2 eToro popular investors, Vlad and Levi, about how military conflicts affect investments. It's a great video because it's not too speculative, and it looks at data. It looks at history and the way that stock markets in the world has dealt with military conflicts before. What about this week? Well, China is more or less closed for business through the entire week because it is their Spring Festival. It's the Lunar New Year. There are a few important pieces of macro data coming out, so lots of PMI data from various economies, as well as the Bank of England's inflation report and interest rate decision, which I'll be watching quite closely. It affects me personally on Thursday of this week. In addition to that, of course, everyone's going to be watching the news to see what Russia does. Everyone at this point is hoping for a diplomatic resolution, but we'll see. And of course, there are a number of companies reporting earnings. This is going to be a mega week for earnings. You can see on screen a number of logos for big companies: Google, Alibaba, PayPal, Amazon, etc., etc., etc. So I think this might be the biggest, or one of the biggest weeks that we'll see in this earnings season. So it's going to be a busy one, lots of earnings reports to read, and lots of thinking to do about how the information we get might play out for the rest of the year. All right, that's it for this week. I'm going to try create a stock analysis video about Square later this week. It's a fantastic business, and like Visa, PayPal, and others within that kind of industry, the stock price has been dropping for a long, long time now. So thanks for listening, and I'll talk to you later in the week. Goodbye.